Welcome everyone. Today we're going to be analyzing Google stock. This is a stock that is up 50% year to date and hit a 52-week low of $83 a share, and it has a 1.7 trillion market cap, which is what it would cost you to buy all the shares outstanding. In this video, we are going to look at the financials, the balance sheet, and use my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, if you take a look at annual revenue growth, we can see that this company used to grow at around 20% in the past, and the percentage of revenue growth since 2019 has come down. This is because as the company gets larger and larger, it is going to be more difficult for them to grow. 2021 was an anomaly year due to COVID, so we cannot value the company based on that year. I don't think that Google is going to do 20% revenue growth in upcoming years. However, they still have revenue growth, and if we take a look at what analysts are expecting, they are expecting an average of 9% annual growth for the next 5 years. So these are the things we have to take into account when we put our assumptions about the future of the company on the Excel spreadsheet. Now, let's take a look at net income and free cash flow, and what we are going to see is that Google is growing both of them, which is definitely a positive. And again, like revenue, I am going to exclude 2021 to value the company. Free cash flow and net income, I believe, are going to continue to grow as they are expected to make $700 billion in free cash flow in 2028. This is a lot, and they are basically a money printing machine. Moving on to their margins, we are going to see that they are very consistent. They have averaged, over the past 5 years, 23% profit margin and 23% free cash flow margin. I love the fact that their margins are very consistent because it makes the company easier to value, in my opinion. Then, the Excel spreadsheet tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. The goal here is to put assumptions that are probable. For example, for revenue growth, Google is expected to grow at 9% rate for the next 5 years. But I also think it's probable that they grow 12% if things go right for them with Google Cloud, for example, which reached $8 billion of revenue last quarter. And if things do not go as planned, I think it's also reasonable that they grow at 6%, which could happen as their ad business, which is their main business, continues to slow down. We have also taken a look at their margins, which are very consistent. And I think it's reasonable to assume that they are going to do between 20 and 26% over the next 7 years. Then for P/E price to free cash flow, what I do is I start at 15, and depending if the company has growth potential and moat, I assign a higher or lower multiples. Google has some growth potential, but has one of the best moats out there. They own 2 of the largest search engines in the world, which are Google and YouTube. This is why I went with multiples of 18, 20, and 22. Finally, the desired annual return is the return you want to get each year on your investment. And because you can get around 9% investing in an ETF, if you take the risk of investing in an individual stock, you should desire a higher return. And as your assumptions get less probable, you should put a higher return as a margin of safety. And this is why I went with 10%, 12%, and 14%. As you can see, there are 6 numbers. The top 3 are based on net income or profit margin, and the bottom 3 are based on free cash flow. In this case, they are the same because I put the same percentages for profit margin and free cash flow. And what these numbers mean is that you need to pay these prices in order to make the desired return that I have put in. And Google is a buy according to my high assumptions. According to my middle assumptions, you should buy the stock at $119. And according to my low assumptions, you should buy it at $90 a share. So when Google was trading at $83 a share, it looked very good. Now, the Excel spreadsheet does not take into account the balance sheet of the company. So let's quickly take a look at it. Google has $118 billion in cash and $26 billion in debt. Therefore, this is basically a perfect balance sheet. My conclusion is that Google is a fantastic company that I want to own because of the great fundamentals, great balance sheet, and very good financials. However, it looks a bit expensive currently, and I hope it falls back to where it used to be in order to buy it. As always, remember that this is not financial advice and you should do your own research. I hope you enjoyed the analysis, and I'll see you on the next one.